Hello and welcome to the Matthew Douglas Model Portfolio Review for Q4 2018. In this review, we'll be looking at markets, the performance of the models, and any fund changes that we're recommending to clients. For the quarter to 11th of January 2019, we saw the S&P 500 down 1.96%, the UK top 100 companies was down 1.27%, and the MSCI Asia ex-Japan was up 7.65%. For the past 12 months to 11th of January 2019, we saw the S&P 500 down 0.53%, the UK top 100 companies was down 11.06%, and the MSCI Asia ex-Japan was down 12.1%. So what has driven markets? The final quarter of 2018 was not good for equity markets. Investors have had to contend with rising US central bank interest rates, a sharp slowdown in Eurozone business confidence, weaker Chinese growth, and rising geopolitical concerns, which include Brexit, Italian politics, and the ongoing trade conflict between the US and China. This all proved an indigestible cocktail for investors. On the plus side, over the quarter as a whole, government bonds at least lived up to their traditional role as the defensive part of a well-balanced portfolio. In the States, the quarter's volatility started with the Federal Reserve Chairman Jerome Powell's comments that the US policy rate was still a long way from neutral, this implying that the Fed wasn't about to stop increasing interest rates anytime soon. US government bond yields moved higher to a price in a faster pace of rate rises, with the US 10-year Treasury bond briefly rising above 3.2%. Equity investors soon started to worry about the potentially faster than expected pace of interest rate rises, and equity sold off. In Europe, business surveys have been weakening all year, but this quarter moves closer to the level that was historically being consistent with not just a slowdown in the pace of growth, but an outright contraction. Political tensions likely contributed to a sharp fall, both in the Italian and French business surveys. Germany still appears to be growing, but it is slower, at least for now. Part of the reason for the slowdown in Europe has been a sharp decline in the manufacturing exports orders, which appears attributable, at least in part, to a slowdown in demand from China, but domestic political factors have also been a drag. In the UK, wage growth has also been accelerating, rising at the fastest pace since the financial crisis. On the other hand, the ongoing uncertainty surrounding the Brexit vote has weighed on business and consumer confidence. House prices and particularly the number of transactions are also being affected by the uncertainty. Against this backdrop, the Bank of England maintained rates at 0.75%. The political theatre around Brexit will inevitably reach its most dramatic point in this final act. We will now have a look at the performance of the models. For the quarter to 11th of January 2019, we saw the cautious portfolio down 0.21% and the realistic portfolio down 1.11%. For the 12 months to the 11th of January 2019, we saw the cautious portfolio down 1.76% and the realistic portfolio down 4.24%. Although we do not like to see negative performance on the models, we are pleased that the models have been able to perform in line with our expectations relative to the performance of the UK stock market. We've found that the higher exposure to bonds and UK property alongside a lower exposure to domestic UK equities has meant that the performance in lower risk portfolios has been better than those higher risk portfolios. Although this has helped over the past quarter, we have found that asset managers and investors are looking more favourably on UK equities as they see them as being priced nearer the long-term average, whereas some overseas markets like the US look expensive in comparison. We shall now have a look into the review of the funds used in the models. So the top performing fund over the quarter was the Merian Asia Pacific, which was up 5.53%. Over the year, the top performing fund has been the Legal & General UK Property Fund, which was up 5.1%. This fund currently has a yield of 4.6%, and we've been pleased to see an underweight exposure to UK retail property. Alongside this, the fund has approximately 20% in cash, which means it has a large amount of liquidity, which is important with the Brexit negotiations coming to an end. The bottom performing funds for the quarter was the Schroder UK Smaller Companies, which was down 4.61%. This was followed by Vanguard and Schroders in the US, which were down 2.47% and 1.55% respectively. The Fed's positioning on interest rates and President Trump's continued trade talks with China really adding volatility to these funds. The Schroders UK Smaller Companies Fund, being more domestic UK companies, continues to bear the effects of uncertainty surrounding Brexit. Over the year, the bottom performing fund was the Merian Asia Pacific, which was down 13.38% due to the China slowdown concerns. The Schroder UK Companies was down 11.63%, and again this continues to be due to Brexit concerns. Although we have found other smaller company funds perform well against Schroders, a deeper look into these funds shows that an exposure to the AIM market, which we feel nervous about exposing to our models. The reason for this is down to low liquidity at times of market stress. We've not made any changes to the funds in the model portfolios during this review. We have, however, raised concerns with three funds, which I'll now explain. We are reviewing the use of Standard Life Global REITs, Schroders US Midcap, and the Kames Investment Grade Bond Fund. So first we'll look into Kames. So for Kames, we saw the performance of the fund detract from the sector and the peer group. This has been in the models for 12 months now and had been working until the last quarter of 2018. In Q4, Stephen Snowden left the fund. He was one of two fund managers on the fund. Stephen's departure to Artemis meant that the fund saw some outflows, and so to protect existing investors, the fund swung its pricing, which meant the value dropped 0.7%. This was to discourage withdrawals in following Stephen to Artemis. The fund was also overweight financials in 2018. This position and some slightly shorter duration in bonds contributed to the underperformance against the peer group. With the performance detracting from the peer group and the fund manager leaving, we have had to raise the flag on this fund and consider whether a change is needed. In reviewing this fund, we're considering options from other companies such as Legal & General, Royal London, Vanguard and BlackRock. Something that has come out in our research so far is that although other funds may look to have performed better, this may be down to a lower holding in quality debt and having longer term duration. Part of our analysis will be looking into how the managers are able to protect investors against default risk, but also maintaining liquidity in tough market conditions. So for Standard Life investors and the Global REIT Fund, in June 2016, the fund saw its performance knocked by the result of the Brexit referendum and subsequent weakening of sterling. With the fund hedging back its overseas currency exposure, this meant that that SLI were not able to benefit from the currency boost that we saw in other overseas funds. At this time, we reviewed the fund and felt it was worth keeping, as moving to another peer group fund would have meant losing the currency hedge, and so selling something at a cheap price to buy something at an expensive price. In our January review, we found that SLI has continued to perform well when you take out the vote from the referendum. Having a currency hedge to the fund has worked well to manage the volatility against the peer group over the past 2 years. As part of our recent review, we've considered global property funds which have some direct bricks and mortar as well as property shares. In this, we have found another Standard Life fund and one from HSBC to be particularly interesting. Both use a mix of direct property and shares on a global basis. Both have performed well against the current REIT fund with Standard Life, but both cost more than the current fund. Our view has been that properties should diversify our shares and bond exposure. Over the course of the next quarter, I will be corresponding with Standard Life and HSBC to really understand the makeup of these two new funds, see how they could diversify the models, and whether the cost is worth the expense by our clients. And then last but not least is the Schroder US Midcap. Over the quarter, we found that Vanguard performed in line with its index. Schroders, focusing more on the mid to smaller companies in the US, underperformed the S&P 500. Although this is to be expected as it's not holding blue chip stocks, we decided it would be worth reviewing the North American exposure to see if there's a better fund for us to partner with the Vanguard tracker. Our view is that we need diversification away from the tracker fund, as this doesn't offer enough diversification or protection in tough markets. We also believe that holding smaller companies in the long term generates alpha or outperformance. In reviewing our North American exposure, we have had to be mindful of a star bias. A lot of top performing stocks are growth stocks like Facebook or Amazon. Growth as a style has performed well since 2009. However, there is a lot of data showing that over longer term periods, value stocks offer better returns. It's important not to ignore one style. We want to have funds that benefit from both styles, as each operates at different stages of the economic cycle. Equally, it's important not to be biased to one style, as this may mean you miss out on up-and-coming companies that are linked to a change in trends. One example of this is Amazon with the growth in online retail. We are considering funds from companies such as T. Rowe Price and HSBC. We will have completed the research of the free funds under review and will be in a position to make a call on whether any action is needed in our April 2019 Investment Committee meeting. Thank you for joining me to review our model portfolios, and I look forward to sharing our views with you in April.